Have you ever wondered whether your money is actually safer sitting in a bank than invested somewhere else? For decades, millions of Americans believed the answer was simple. Open a checking account, keep some savings in the bank, and everything would be fine. But over the last few years, that confidence has started to change. We've seen regional banks collapse almost overnight. We've watched interest rates climb to levels many people never expected. And suddenly, questions that once seemed unimportant are now being asked at kitchen tables across America. Should you keep large amounts of cash in your checking account? Is your savings account earning enough to keep up with inflation? Would Treasury bills be a smarter place to park your money? And most importantly, if another banking crisis happens, are you actually prepared? In today's video, we're going to break down exactly what every American should understand before making any major decision with their cash. We'll compare checking accounts, savings accounts, Treasury bills, and explain why so many financial experts have changed the way they think about keeping money in the bank. By the end of this video, you'll have a much clearer understanding of where your money works hardest, what risks actually exist, and how to make informed decisions without falling for internet myths or financial headlines. Before we begin, if you enjoy straightforward videos about investing, retirement, personal finance, taxes, and building long-term wealth, make sure to subscribe to the channel and turn on notifications. Every week, we break down complicated financial topics into simple, practical advice that anyone can understand. Now, let's dive in. For many years, interest rates stayed incredibly low. If you had money sitting in a checking account, you probably earned almost nothing. Even many traditional savings accounts paid only a fraction of 1% each year. Most people accepted that because there simply weren't many alternatives for cash that felt equally safe and easy to access. Then, everything changed. Inflation began rising. The Federal Reserve responded by increasing interest rates faster than it had in decades. Suddenly, cash started becoming valuable again. Banks began raising savings account rates. Money market funds became more attractive. Treasury bills started offering yields that many Americans hadn't seen in years. For retirees, conservative investors, and families saving for major expenses, this created an entirely new conversation. Instead of asking, "Where should I invest?" people started asking, "Where should I keep my cash?" That's an important difference. Cash isn't meant to generate enormous returns. Its primary job is stability, liquidity, and protection. But that doesn't mean all places to store cash are equally beneficial. Imagine two people who each have $50,000 set aside for emergencies. One leaves the money in a checking account, earning almost nothing. The other places the cash into short-term Treasury bills or a high-yield savings account while still maintaining access to emergency funds. After 1 year, the difference may not seem life-changing. But over several years, the gap becomes much larger. Without taking unnecessary investment risk, one person allowed idle cash to produce additional income while the other received very little in return. That's why understanding today's interest rate environment matters. Your cash should work for you whenever possible. That doesn't mean chasing risky investments. It simply means knowing the difference between convenience and efficiency. Checking accounts were never designed to maximize returns. They're designed for spending money, paying bills, receiving direct deposits, writing checks, using debit cards, handling everyday financial activity. They're excellent tools for daily banking. But they're usually poor long-term storage accounts for large balances. Savings accounts were created for a different purpose. They allow your money to remain relatively accessible while potentially earning more interest. Some online banks now offer significantly higher yields than many traditional brick-and-mortar institutions. Then there are Treasury bills. Treasury bills, often called T-bills, are short-term debt securities issued by the U.S. government. They mature in periods ranging from a few weeks to 1 year, and many investors use them as a place to hold cash they won't immediately need. One reason they're popular is that they're backed by the full faith and credit of the United States government. While every financial decision involves considerations and trade-offs, many investors view Treasury bills as among the lower-risk places to hold short-term cash. Of course, no single option is perfect for everyone. A checking account offers immediate access. A savings account may provide a higher yield while maintaining liquidity. Treasury bills may offer competitive returns but require you to understand how maturity dates work. The right choice depends on your financial goals, your need for access to cash, and your overall financial plan. Unfortunately, many Americans never compare these options. They simply continue using the same checking account they've had for 20 years without asking whether that money could be working harder elsewhere. That doesn't necessarily mean they're making a mistake, but it does mean they may be missing an opportunity. Over the past few years, financial headlines have added another layer of concern. When regional banks experienced failures, many depositors began asking questions they had never considered before. What happens if my bank runs into trouble? Is my money protected? Should I spread my cash across multiple institutions? Those are reasonable questions. Fortunately, understanding the answers is much easier than many people think. In the next section, we'll discuss how bank protection works, what FDIC insurance actually covers, and why understanding those limits can help you make smarter decisions about where you keep your money. One of the biggest concerns people have today is simple. What happens if my bank fails? It's a fair question, especially after several regional banks made headlines in recent years. News coverage showed long lines outside bank branches, customers rushing to move their money, and constant speculation about whether more banks might be next. For many Americans, it was the first time they had seriously questioned the safety of their bank deposits. The good news is that the U.S. banking system includes important protections that many people overlook. If your money is held at an FDIC-insured bank, your deposits are generally protected up to the applicable insurance limits, provided your accounts meet the coverage requirements. That protection applies to common deposit accounts, such as checking accounts, savings accounts, money market deposit accounts, and certificates of deposit. This is why it's important to know not only where your money is located, but also how your accounts are titled. Many people assume every dollar they have at one bank is automatically protected without limit. That's not always the case. Coverage depends on factors such as ownership categories and the total amount of insured deposits held at the same institution. For example, an individual account is treated differently from a joint account, and certain retirement accounts may have separate insurance rules. This doesn't mean you should panic if your savings have grown over the years. It simply means understanding your coverage can help you make smarter decisions. Some retirees choose to spread larger cash balances across more than one FDIC-insured institution. Others work with their bank to structure accounts in ways that maximize available insurance under existing rules. The important point is that these decisions should be based on accurate information, not fear. Another common misunderstanding is the difference between a bank deposit and an investment. Money in a checking account is a deposit. Money in a savings account is also a deposit. Those accounts may qualify for FDIC insurance when held at an insured institution. However, investments such as stocks, mutual funds, ETFs, and corporate bonds are different. Their value can rise or fall with the market, and they are not protected by FDIC deposit insurance simply because you purchased them through a bank. Understanding that distinction helps eliminate a lot of unnecessary confusion. Now let's talk about another issue many people overlook: inflation. Even if your money is completely safe, it doesn't necessarily mean it's growing. Imagine inflation averages 3% over several years while your checking account earns almost nothing. Your account balance may stay exactly the same, but the purchasing power of those dollars slowly declines. In other words, the money buys less than it did before. That's one reason financial planners often encourage clients to separate emergency cash from long-term savings. Emergency funds should remain easily accessible, but cash you don't expect to use for several months, or even longer, may deserve a different strategy. That's where comparing options becomes valuable. High-yield savings accounts have become increasingly popular because many online banks offer significantly higher interest rates than traditional checking accounts. Money market deposit accounts may also provide competitive yields while maintaining relatively easy access to your funds. Treasury bills have attracted attention as well because they are backed by the U.S. government and have offered attractive short-term yields during periods of higher interest rates. Each option has advantages. Each also has trade-offs. The key isn't finding one perfect solution. It's matching the right tool to the right financial goal. For example, the money you use every week to pay bills belongs in a checking account. Your emergency fund may fit well in a high-yield savings account where it remains accessible while earning interest. Cash you know you won't need for several months might be appropriate for short-term Treasury bills, depending on your personal situation and liquidity needs. Notice that this approach isn't about choosing one account over another. It's about giving every dollar a purpose. Too many people allow convenience to make financial decisions for them. They open one checking account decades ago and never revisit whether it still meets their needs. Meanwhile, interest rates, inflation, technology, and banking products continue changing around them. A quick review of your accounts once or twice each year can make a meaningful difference over time. Ask yourself a few simple questions. Is my emergency fund earning a competitive return? Am I keeping more cash in my checking account than I actually need? Do I understand what protections apply to my deposits? Could part of this money work harder without taking unnecessary risk? Those questions don't require you to become a financial expert. They simply encourage you to become a more informed saver. In the next section, we'll compare Treasury bills, high-yield savings accounts, and traditional bank accounts side by side, so you can better understand which option may fit different financial goals and why so many investors have been rethinking where they keep their cash. Let's take a closer look at the 3 most common places Americans keep their cash, because each one serves a different purpose. The first option is your everyday checking account. This is the account most people use for direct deposits, paying bills, writing checks, and making purchases with a debit card. It's designed for convenience and easy access, not for generating investment-like returns. For that reason, many financial professionals suggest keeping only the amount you need for your normal monthly expenses in your checking account. If a large cash balance sits there for months without being used, it may not be working as efficiently as it could. The second option is a high-yield savings account. Unlike many traditional savings accounts, some high-yield accounts offered by banks and credit unions pay significantly higher interest rates. The exact rate changes over time and varies by institution, but the goal is the same, allowing your cash to earn more while remaining relatively accessible. For many households, a high-yield savings account can be an excellent place to keep an emergency fund. Imagine your furnace suddenly stops working in the middle of winter, or your car needs an expensive repair. Maybe an unexpected medical bill arrives. Those are situations where quick access to cash is extremely valuable. Because the money remains liquid, you don't have to sell long-term investments during a difficult market just to cover an emergency expense. The third option is Treasury bills, often called T-bills. Treasury bills are short-term securities issued by the U.S. Treasury. Investors purchase them for a set period, which may range from just a few weeks to 1 year. When the bill reaches maturity, the investor receives the principal back, along with the return earned according to the purchase price. Many conservative investors appreciate Treasury bills because they're backed by the U.S. government and have historically been considered among the lower-risk places to hold short-term cash. However, Treasury bills are different from a checking account. If you know you'll need the money next week to pay your mortgage or utility bills, locking those funds into even a short-term investment may not be practical. That's why understanding your timeline is so important. Ask yourself a simple question. When will I actually need this money? If the answer is tomorrow, a checking account probably makes sense. If the answer is sometime within the next few months, a high-yield savings account may offer a good balance between accessibility and interest earnings. If the answer is 6 months from now and you don't expect to touch the money before then, Treasury bills may be worth exploring as one possible option. Notice that each account has a different job. Your checking account handles spending. Your savings account protects your emergency fund. Treasury bills can help idle cash earn a competitive return while remaining relatively conservative. Another mistake many people make is chasing the highest advertised interest rate without reading the details. Sometimes promotional rates last only a limited time. Some accounts require minimum balances. Others may limit certain types of withdrawals. Before moving money, always understand the terms and conditions of the account you're considering. A slightly higher interest rate isn't always the better choice if the account doesn't match your financial needs. It's also important to remember that interest rates change. The rate you see today may not be the same rate available 6 months from now. That's why reviewing your savings strategy once or twice a year is a smart financial habit. A few minutes of review could potentially improve the return on your cash without changing your overall level of risk. Let's also address another question many retirees ask. Should I move all of my money out of my bank? For most people, the answer is no. Healthy financial planning usually isn't about making dramatic, all-or-nothing decisions. Instead, it's about diversification and purpose. Some money belongs in checking. Some belongs in savings. Some may be appropriate for short-term Treasury securities or other conservative cash management tools. By giving every dollar a specific job, your financial plan becomes stronger and more organized. The goal isn't simply earning the highest possible return. The goal is balancing safety, liquidity, flexibility, and income in a way that supports your personal financial goals. Many successful retirees don't constantly chase the newest financial product. Instead, they build a system that works through different economic conditions. When interest rates rise, they review their options. When rates fall, they adjust if necessary. They stay informed without reacting emotionally to every headline. That's an important lesson for every investor. Financial success often comes from consistency rather than constant change. In the next section, we'll discuss how interest rates set by the Federal Reserve influence checking accounts, savings accounts, Treasury bills, and even your everyday financial decisions, and why understanding that relationship can help you make smarter choices with your money. Now let's talk about one of the biggest forces that influences where your money earns interest, even though most people never see it directly. It's called the Federal Reserve. You may have heard news anchors say, "The Federal Reserve raised interest rates," or "The Fed is expected to cut rates next month." But what does that actually mean for your checking account, your savings, or your cash investments? The Federal Reserve, often referred to simply as the Fed, is the central bank of the United States. One of its responsibilities is to help promote stable prices and support a healthy economy. To do that, it adjusts short-term interest rates in response to changing economic conditions. When inflation rises too quickly, the Fed may increase interest rates in an effort to slow spending and reduce inflationary pressure. When the economy weakens, the Fed may lower interest rates to encourage borrowing, investing, and economic activity. Those decisions don't just affect Wall Street. They eventually affect everyday Americans. Let's start with savings accounts. When the Federal Reserve raises interest rates, many banks gradually increase the interest they pay on savings accounts, certificates of deposit, and certain money market deposit accounts. While not every bank adjusts rates at the same speed, higher rate environments often create better opportunities for savers. That's one reason many people paid closer attention to their savings accounts after interest rates began rising. For the first time in many years, cash could earn a meaningful return without being invested in the stock market. Treasury bills also tend to respond to changes in interest rates. Because they are short-term securities issued by the U.S. Treasury, newly issued Treasury bills often reflect the current interest rate environment. When rates move higher, newly issued T-bills may offer higher yields than older ones. When rates move lower, future T-bill yields generally decline as well. This is why many investors regularly compare current Treasury bill yields with the rates available from high-yield savings accounts. Neither option is automatically better. The right choice depends on your financial goals, your need for liquidity, and how long you expect to leave the money untouched. Now let's discuss borrowing. Higher interest rates don't just reward savers. They also increase borrowing costs. Mortgage rates may rise. Auto loans can become more expensive. Credit card interest often increases. Home equity loans may cost more. In other words, while savers may benefit from higher rates, borrowers often face larger monthly payments. This creates an interesting balancing act for many families. Someone saving for retirement may appreciate earning more interest on cash. At the same time, they may postpone buying a new home or financing a vehicle because borrowing has become more expensive. Economic decisions rarely affect only one part of your financial life. Everything is connected. That's why understanding the bigger picture matters. Another mistake many people make is reacting emotionally every time the Federal Reserve announces a rate decision. Financial news often treats these announcements as major events. Markets may move dramatically. Headlines become more sensational. Commentators make bold predictions. But long-term investors usually avoid making sudden financial decisions based on a single announcement. Instead, they focus on their overall financial plan. If your emergency fund is properly funded, if your retirement investments match your long-term goals, if your debt is manageable, And if your cash is earning a competitive return, then one Federal Reserve meeting is unlikely to require major changes. Consistency often produces better results than constantly reacting to short-term news. It's also worth remembering that interest rates don't stay high forever. History shows that rates move in cycles. Sometimes they're elevated. Sometimes they're much lower. That's why choosing financial products based only on today's rate can sometimes be short-sighted. A better approach is building a flexible system that continues working under different economic conditions. For example, many financially successful households maintain enough cash for emergencies while investing the remainder according to their long-term goals. They understand that cash serves one purpose. Investments serve another. Retirement accounts serve another. Each part of the financial plan has its own role. That's a much healthier mindset than trying to move all of your money every time interest rates change. Financial planning isn't about predicting the next Federal Reserve decision. It's about preparing for whatever decision eventually comes. In the next section, we'll cover some of the most common mistakes people make with their cash, the simple habits that can improve financial security, and a practical checklist you can use to make sure your money is working as efficiently as possible without taking unnecessary risks. Now that we've talked about checking accounts, high-yield savings accounts, Treasury bills, and the impact of interest rates, let's focus on something even more important: your financial habits. The truth is, building wealth isn't always about finding the highest return. More often, it's about avoiding expensive mistakes. Many Americans spend hours searching for the best savings account while ignoring financial habits that have a much bigger impact over time. Let's look at a few of the most common mistakes. The first mistake is keeping too much money in a checking account. A checking account is designed for convenience, not long-term growth. It's the place where your paycheck arrives, bills are paid, and everyday purchases are made. But once your monthly expenses are covered, leaving a very large balance sitting there month after month may not be the most efficient use of your cash. Many financial planners recommend separating everyday spending money from longer-term savings. That doesn't mean emptying your checking account. It simply means giving every dollar a purpose. Money you'll use this month belongs in checking. Money reserved for emergencies may be better suited for a high-yield savings account. Cash that won't be needed for several months might deserve another look, depending on your personal financial goals and risk tolerance. The second mistake is failing to build an emergency fund. Life rarely goes exactly as planned. A medical expense, a home repair, a vehicle breakdown, unexpected travel. These situations happen to nearly everyone. Without an emergency fund, many families end up relying on high-interest credit cards or personal loans just to cover temporary expenses. That's why financial experts often emphasize having accessible cash available for emergencies. The exact amount depends on your individual circumstances, but having a dedicated reserve can provide valuable peace of mind. Another mistake is chasing every new financial trend. Every year, there's a new investment everyone claims is guaranteed to outperform everything else. One month, it's cryptocurrency. The next month, it's artificial intelligence stocks. Then it's real estate. Then precious metals. Successful investors rarely build long-term wealth by constantly chasing whatever happens to be popular at the moment. Instead, they focus on consistency. They save regularly. They invest thoughtfully. They review their financial plan periodically. And they avoid making emotional decisions based on headlines. Let's also talk about inflation. Many people focus only on how much money they have. A better question is how much purchasing power that money has. If inflation rises faster than your savings, the value of your cash gradually declines over time. That's why periodically reviewing where your savings are held can be an important part of long-term financial planning. Another habit worth developing is reviewing your accounts at least once or twice each year. Ask yourself a few simple questions. Is my checking account balance larger than it needs to be? Is my emergency fund still appropriate for my current lifestyle? Am I earning a competitive interest rate on my savings? Have my financial goals changed since last year? Those questions take only a few minutes to answer, but they can help ensure your money continues working efficiently. Technology has also made managing cash much easier than it was years ago. Many banks now allow automatic transfers between checking and savings accounts. You can schedule recurring transfers every payday. Instead of relying on willpower to save money, automation allows saving to become part of your normal routine. Small, automatic transfers may not seem significant at first, But over several years, they can produce impressive results without requiring major lifestyle changes. Another smart habit is resisting the temptation to compare your finances with everyone else's. Social media often highlights expensive vacations, luxury cars, and extravagant lifestyles. What it rarely shows is the debt, financial stress, or lack of savings that sometimes exists behind the scenes. Financial success isn't about impressing strangers. It's about creating stability for yourself and your family. That means making decisions based on your own goals, not someone else's lifestyle. One final point deserves special attention. Financial planning isn't something you do once and forget forever. Your income changes, your expenses change, interest rates change, the economy changes, your retirement goals may change as well. Reviewing your financial strategy regularly allows you to adjust gradually instead of reacting during a crisis. The most financially confident people aren't necessarily the ones earning the highest income. They're often the ones who understand where their money is, why it's there, and what job each dollar is performing. In our final section, we'll bring everything together with a simple action plan you can begin using immediately. Whether you're just starting to organize your finances or you've been managing money for decades, these practical steps can help you make more informed decisions and build greater financial confidence for the years ahead. Before I wrap up today's discussion, let's take one final step back and focus on the bigger picture. We've talked about checking accounts. We've compared high-yield savings accounts and Treasury bills. We've discussed how the Federal Reserve influences interest rates. And we've covered several financial habits that can help protect your money over the long term. So, what's the single most important lesson from all of this? It's simple. Your money should always have a purpose. Every dollar you earn should have a job. Some of your money is there to pay this month's bills. Some should be available for unexpected emergencies. Some should be working toward your retirement goals. And some may be invested for future opportunities. When every dollar has a purpose, managing your finances becomes much easier. Instead of wondering where your money went each month, you'll know exactly why it's sitting where it is. That creates confidence. And confidence is one of the most valuable financial assets you can have. It's also important to remember that good financial decisions don't have to be complicated. You don't need to predict the stock market. You don't need to guess where interest rates will go next year. And you don't need to react every time a dramatic financial headline appears online. Most successful long-term investors follow a surprisingly simple strategy. They spend less than they earn. They save consistently. They keep an emergency fund. They avoid unnecessary debt whenever possible. They review their financial plan regularly. And they make adjustments only when their personal situation changes, not because of panic or fear. If you're retired or getting close to retirement, this approach becomes even more valuable. Protecting the money you've already worked so hard to build is often just as important as continuing to grow it. That means understanding where your cash is held, knowing how much liquidity you need, reviewing your accounts periodically, and making sure your financial decisions still match your goals. Here's a simple checklist you can use after this video. First, review your checking account balance. Ask yourself whether you're keeping more cash there than you actually need for everyday expenses. Second, compare the interest rate you're currently earning on your savings. If it has been years since you looked, it may be worth seeing whether there are more competitive options available. Third, make sure you understand the protection available on your bank deposits and how your accounts are structured. Knowing this information ahead of time is much better than trying to learn it during a financial emergency. Fourth, review your emergency fund. Has it kept pace with your current living expenses? Would it still cover several months of essential costs if something unexpected happened? Finally, schedule a personal financial review at least once every year. Think of it as an annual checkup for your money. Small improvements made consistently over many years often produce far better results than dramatic changes made once in a while. Remember, financial success is rarely built through one perfect decision. It's built through hundreds of small, thoughtful decisions repeated over time. That's true whether you're just beginning your financial journey or enjoying retirement after decades of hard work. The goal isn't perfection. The goal is progress. The more informed you become, the more confident you'll feel about every financial decision you make. And confidence allows you to focus less on worrying about your money and more on enjoying the life you've worked so hard to build. If you found today's video helpful, please take a moment to click the like button. It really helps the channel reach more people who are looking for clear, practical financial education. If you're new here, don't forget to subscribe and turn on notifications. Every week, we share easy-to-understand videos about retirement planning, investing, saving, taxes, Social Security, and personal finance to help you make smarter decisions with your money. Now, I'd love to hear from you. Where do you currently keep most of your cash? Is it in a checking account, a high-yield savings account, Treasury Bills, or somewhere else? Share your thoughts in the comments below. I always enjoy reading your experiences, and your questions often inspire future videos. Thank you so much for watching. Take care, stay informed, keep learning, and I'll see you in the next video.